welcome to March's edition of SFI Not So Live with me, Jay. I'm joined this week by another stellar panel, a couple of people you know, and a new face to the podcast as well. So we'll introduce him in just a moment. So first of all, let's just go around the room and do the introductions, and I'll do the caveats in a minute. Tony, good morning.
Yeah, thanks, Jay. My name's Tony Hall. I'm Head of Business Development here at Saffron for Intermediaries. My role is pretty much making sure that mortgage intermediaries get everything they want from us.
Short and sweet. And Tony's joined by his colleague and a regular on the podcast. Good morning, Phil Lawford. How are you doing?
Morning, Jay. Very well, thanks. I'm Phil Lawford, National Account Manager at Saffron, and I look after our key intermediary and broker relationships.
Wonderful. And a special guest for this month, and a first time with us. Good morning, Brian. It's Brian Murphy from the Mortgage Advice Bureau. Why don't you give us a little introduction, because the audience won't know who you are. So just a little bit about who you are, what you do and where you work.
Sure. Morning, Jay. Morning, everyone. Yes, morning. My name is Brian Murphy. My title is Head of Lending at Mortgage Advice Bureau. For those that are not familiar, we are a national mortgage brokerage. We have around 2,000 brokers right across England, Wales, Scotland and Northern Ireland. And my role primarily is the relationship of our partnerships with our lender partners.
Thanks, everybody. Just for the audience at home, we are a mortgage and property podcast. We discuss everything that's going on in the UK market. We're recording at the end of February 2023, so some of the information and rates and bits that we talk about may be slightly outdated. So, but you do end up might be listening back. So, without further ado, we're going to go through some of the big stories that have been happening over this month, and I'm going to put the stories to the panel. They're going to give us their opinions. Just a little caveat from us that these are our personal opinions, not necessarily that of the companies that we are employed by. So, on that note, on to our very first story, which comes from Mortgage Solutions. We discussed buy-to-let quite a bit, and this story, I think, is something that's really interesting. I think we've touched on it before. The headline is, "Why are buy-to-let lenders moving to variable interest rate and fee structures?" It's an opinion piece, but I think there was some information in there that I think we could do with talking about. So, Tony, I'm going to come to you first. You've taken this structure on, haven't you? Do you want to tell us a little bit about what you've done?
Yeah, well, in some respects, we've always had this structure because we've always had a discounted range of products alongside our fixed rates with, actually a reasonably okay fee, not a high fee. But we have been trying to look at how we, following on from what this article says, how can we make it as easy as possible for buy-to-let landlords to get the amount of money they need to borrow? Because the challenge is the higher the interest rate, getting the rental yield coverage to pay for it on an affordability is getting more challenging. Hence why this kind of innovation has come in, because it enables you to have a lower rate and a higher fee. So from the lender's perspective, it's kind of a net income figure for them. But for the construct for the broker, they're actually able to borrow more because the underlying interest rate that the affordability is stressed against is lower. So that's the premise behind it. I think with interest rates dropping now, you might see a reverse of this again. This was because rates went sky high. Anything over, I think it was, Phil can probably tell a bit more than me, but anything over 5.5% was absolutely killing anybody on an ICR calc. Particularly at 140 or 155, which some lenders stress at. We've been okay because we stress at 125, which makes it easier. But it's a great initiative, and it's definitely helping. And we've seen our variable rated limited company product shoot through the roof. Oh, literally, we're doing bucket loads of it at the moment, which is great. So it means that at least we're able to help the market because they're getting what they want. But the other two, Brian and Phil, can give you probably far better insight than me.
Brian, I'll come to you in a second, but Phil, just carrying on. Tony kind of propped you up for that one, so I'll let you carry that on.
Yeah, I mean, the feedback that I get and our BDMs are getting is it was almost certainly a month ago, and I actually still think we're seeing this in the buy-to-let world still, is it's all about the rental calculation fitting first and foremost, because if the rental calculation doesn't fit, doesn't matter what product is, the business can't be placed, so the landlord then would have to be paying down the mortgage or finding cash to put into it to reduce the balance down for it to fit with lenders' criteria. So I'm all for choice in the market, and I know Land Bay, and there was another lender. They got some stick for launching a product with such a high fee, but it did give choice for brokers and landlords, and yeah, it gave options. Was given options where if they'd have stuck to a traditional smaller fee and higher rate structure, then there would have been a lot of landlords either stuck with the current lender, possibly more mortgage prisoners, or having to pay down the mortgages. So this product has given choice. We've seen success because we've got quite a flexible rental calculation. So that's worked for us as well.
Brian, I'm going to come to you because we're a bit siloed. We're from a lender. So just looking at the wider market, there must be a few of these around. Are they from your perspective? Are you seeing the popularity that Saffron is seeing across the market?
Yeah, absolutely. I mean, going back to, I think, Tony's point, historically, the market has been, let's say, dominated for years now by fixed rates. The fixed rates have become the default product for the majority of the market. Clearly, with the rise in interest rates, has been discussed already, as the ICR, as interest rates have increased quite dramatically. Obviously, base rate was sort of 1% 12 months ago broadly, and here we are with a base rate of 4%, barely 12 months later. Mortgage pay rates have gone up sort of subsequently, broadly in line with that to a degree, and as was already mentioned, once sort of rates got over typically sort of 5.5-6% sort of level, the ICR calcs just weren't working. So what we've seen, not surprisingly, is, I wouldn't quite call it innovation, but changes in pricing in order to try and make products work. And if that means bigger fees and lower pay rates, then that's got to be the right option, at least for a lot of borrowers. It's increasingly apparent as well for a section of the market, where you've got lenders that have securitized their loans and don't have a product transfer proposition. Some of those clients effectively would be beholden to the lender's standard variable rate or revert rate. So by offering these types of products in the market, and more of them, it at least gives people the choice of an exit route rather than reverting to SVR, which for many would be, financially quite crippling, or might result in the worst case scenario with lenders having to go back to their tenants and saying, we're not only putting your rates up, your rent up, we're putting it up substantially in order to cover our own costs. So this gives flexibility, and as Phil alluded to, brokers want choice. It's for the broker to recommend based on the individual client need and circumstance what's the most appropriate, but without choice, the opportunity to recommend is more limited. So anything that gives us that sort of choice and to meet the needs of each and every individual, so much the better.
Great. Tony, you mentioned limited company being popular with Saffron. Isn't the issue, the typical hobby landlords? So, not the ones with the huge portfolios, the ones with the smaller, or not?
I think it's both, to be honest. Rental yields are falling; they're not growing, and rates were going up. That trend is. The problem is, you write an article this week, next week it's all changed in this mad market. So it's a challenging one, but I think it's probably more acute if you only have one property. But the way most lenders work and how we work is we not only assess the whole portfolio has to hit the hurdle rate, each property has to as well. So that's where whether you've got 1 or 100 is irrelevant, because it's that one that you're looking to refinance or finance is the one that we're assessing. So that's the challenge.
Yeah, just jumping in there as well. I was, when we launched our product, I was expecting to see it all predominantly to be remortgages and landlords remortgaging. And when I looked at our business coming in, there's still a lot of purchases going on. So we're seeing purchases which surprised me. So that shows that landlords are still confident in the property market and in UK property. So it's not. I know what was it, our last podcast or the one before that, we were almost saying, is this doom and gloom for the buy to let? And from what I'm seeing on the ground, it's not. I'm not seeing it. it's still there. Yeah,
It's just
yeah,
proved none of us got a crystal ball
yeah,
because we've done stories, haven't we, where buy-to-let's going down. There's going to be no new landlords. It's an impossible market. It's never going to happen, and then we're
Yeah.
proved wrong the next week. That story's you're absolutely right, Phil. Completely out of date. And Brian, I presume that's the same across the board. There's no shutdown. There's no lack of purchasing across the buy-to-let market. It's still
It
buoyant
is
enough.
quieter. It's certainly in our world. It's quieter than perhaps it was 12 months ago. I think that's, as I said, to a degree, a consequence of just pricing. For some deals, they're just not achievable. Even with the sort of high fee, lower rate sort of situations, or perhaps landlords are reluctant to perhaps pay the fees in certain circumstances. But and again, coming back to my point previously, for those lenders that have securitised and there isn't a PT opportunity, i.e. product transfer, some of those clients we can't remortgage at the moment, so they're actually, to a degree, some of those customers are stuck. They won't necessarily be stuck in the longer term, as the market continues to improve, and it is improving, and rates are starting to ease and fall back a little bit. So thereby, we will be able to sort of find sort of further solutions for more and more of those clients as time moves on. So yes, and as Phil alluded to, there is still an appetite for purchase. It's not ceased. It's probably slower and it's quieter. But again, for landlords who are, let's say, professional, in this for the long term, this is their job, their career, their occupation, their business. These people are always on the lookout for new property, because if they can get the right yield, that's what drives their business. And the cost of finance, yes, it's important, but it's not necessarily the overarching criteria.
But there we go. Thanks, guys. That was a nice wide round discussion there. We're going to talk about rates in a little bit, so we'll come back to that. But we're going to stick with the cost of living slightly. Tony, I know you were keen to talk about this one, so I'm going to come to you first on it. But it's on the intermediary. 1 in 10 are forced to delay retirement plans due to the cost of living. We did a Rio chat. God, was that 2 months ago? I can't remember now. We've done a recently Rio chat, but just let's just pick apart this story a minute. Cost of living crisis is affecting everybody, and I think we can all feel the pinch and see the pinch. Why do you? Well, we know why, but what's your opinion on this story with regards to people changing their retirement plans?
Yeah, well, look, I think there's many facets to this. One, it's getting harder to well, if you haven't planned your retirement effectively, it's getting harder to retire with an increasing cost of living. Yeah, and let's not beat around the bush. Majority of people in this country do not plan an appropriate retirement. Okay, it's just again, it's one of those things that's just not drummed into people in significant quantity to make it hit, and you only realise it when you bloody need it. Excuse my French, which is a little bit too late. Hence, we have this problem. But I think what the article is stating, and what I'm passionate about this, is people not realising they're sat on a huge part of their retirement planning, which is their house, and that doesn't mean they have to sell it. Or downsize to release equity from it. There are ways that you can borrow against your house while still living in it. And I know this is focused very much on equity release, but there are, opportunities within the normal mortgage market, lending into retirement, lending into older age, Rio, where you can borrow, the money that you already own. It's just not a tangible asset. That's the problem. People think they're borrowing money in later life and don't want to do it, and some will return to work rather than thinking, gosh, I don't want to own money, I'll go and get a job. Or actually they don't need to, they're just turning an intangible asset to a tangible asset. And but it's a psyche, it's a British psyche of, I've got to pay my loans off, then I'm clear, I don't want to get debt again. And I think we've got to break that mold and show people that there's ways and means of having a lifestyle that you want without having to work much longer than you ever envisaged. So it's a multiple lot of factors. But I suppose the article and what I'm saying to people is, don't just sit in a house being miserable. Let it work for you.
I agree with that. Just on that, I mean, people are working later, aren't they? People are, working well into their 60s, sometimes into their 70s. So, it is just as you say, it's the situation we're in. But Phil, Tony's absolutely right, isn't he? Your house is an asset, and it should be used as such. And it is that change of mindset. Do you think we're seeing that change of mindset in people? I mean, they're having to change their plans, so clearly they were planning to do things differently. But the cost of living crisis means we have to adapt, right?
Absolutely, we've got to adapt. I still think we're in the UK, we're the later life lending market is still in its infancy, and hopefully we will see more um, you know evolution of the concept of later life lending. So this is hopefully phase one, and we'll see it become more innovative, because I think that's probably what this area of the market needs is probably more innovation. I think part of the problem is back in the sort of 80s, early 90s, there was some very bad equity release out there, and it's still been tarred with that. The market, the later life market has been tarred with that. That was a combination of high interest rates, bad lending decisions, and combined with some bad investments. So those days are behind us. The market's now very well regulated, and we've moved on. And as Tony says, it's almost changing the psyche and having that new conversation.
Brian, to just we've mentioned Rio, we've mentioned equity release. There are some differences out there, aren't there? There's a lot of brokers that listen to this podcast. If you were to give them some advice in your learned experience, what's out there that they can look for these people that they can look at different alternatives?
Yeah, I think as has perhaps been alluded to already, age is just a number these days. We see people who are and able to take unfortunately able to take mortgages now in their 70s and potentially even into their 80s. As I've said earlier, each and every circumstance is different, and we shouldn't be using a one-size-fits-all approach. There are a variety of different products which would serve clients better or in different ways. ER, as you mentioned, or Rio, and even TO, term interest only. So we see people come to us perhaps at various points in their, let's use the term, past normal retirement age, whatever normal retirement age now is, who are willing and able and wanting to take a term interest only product. For instance, they need to raise some money for a particular purpose. It might be to help fund a sibling or a grand sibling or something of that sort of nature, maybe into the housing market or something of that sort of nature. They're more than capable of paying a mortgage. They have income. I know here we're talking more specifically about the challenges of the current sort of cost of living crisis and so forth. And again, a lot, as I think Tony alluded to, there are a lot of people out there who haven't perhaps planned their retirement in the way that would perhaps work best for them. Their money is not going as far as it would have done, or perhaps they're not generating as much money as they thought they were going to, because again, things like annuity rates have been relatively low for a number of years. Perhaps pension funds have not performed particularly well from an investment return perspective, and of course, the price of everything has gone up, exponentially relative to what we've done historically, and as a consequence, more and more people are either having to go back to work. Again, there has been certainly, I think, since the pandemic, there have been a sort of body of people that, let's say, retired early or appeared to retire early, or maybe sort of took time out and then haven't returned to the workplace, who perhaps would have done. Some of those have gone back perhaps only on a part-time basis, and perhaps they're using sort of other forms of savings or investments to live on. And again, some of those products are probably coming under pressure now because of inflation being where it is. But from a product sort of perspective, there are a lot of solutions out there, and I think it's an old adage, but there are a lot of people out there who are asset rich and cash poor, and there are many products that can be utilised to certainly sort of give them a much better lifestyle. And again, I don't think we should be giving in a context like this sort of generic advice, but again, from our perspective, come and speak to a whole of market broker. There are plenty of options out there, and have that conversation, because for some people ER might be the appropriate product, for some a Rio might be the appropriate product because they can actually service debts because they have that right level of income, and for others it might be that they can service debt only for a finite period, and hence the term interest only type sort of products combined with other products. And that's where brokers need to, customers and borrowers need to be sitting down with mortgage advisors and ER advisors, and also in some cases financial planners, to actually sort of look at their holistic picture and plan accordingly, and rather than perhaps looking at everything in a silo.
Yeah, Brian's hit the button on the head there. It's about this, and this has been a topic that's been revolving round, particularly in the equity release world for a few years, about this need for holistic advice. And actually, we are very siloed as industries. You've got investments and pension, you've got mortgage, and you've got equity release, and regulation makes it hard to do all three. It's not the easiest thing to combine. It's a lot of skills to be technically competent for, but it's kind of what's needed in this environment. Do I do pension drawdown and erode my fund? Do I use my house as the asset? Is that cheaper? It is a minefield, and it is one that as a collective industry we overall need to solve at some point.
Do you think it's a failure of the Brits? Because in most other countries, I know a lot of people, and in this country, high net worth people might use financial advisors that can give them advice and planning for the future. We're not so confident, well, not so inept in doing that, are we? I know there's a lot of us. I know I'm going to speak from an example here, that I've gone self-employed and all of a sudden my whole life changed and I need to look at my finance in a completely different way, manage my own pension and make sure I'm still paying into my pension, say I've got something for later life. Is there something to be said here that perhaps we need to take better advice when we're younger? And not just because we're obviously constantly asking people to seek mortgage advice, but actually we need wider financial advice for planning ahead, don't we? Do you think it's an education piece, Phil? We talk about education quite a lot, you and I, don't we? And do you think it is a lack of understanding from people as they go through life?
Yeah, absolutely. I mean, Tony said before on previous podcasts, it needs to start at school. The lack of the lack of financial education in schools is it's apparent, because the conversations I have with my kids and that, and you can see that they're not getting that education at school, so they're not coming out of school with that little bit of nous. As in my generation as well, we had mortgages probably quite a lot earlier and a lot younger as well. So we had to learn younger and probably make some mistakes a bit younger.
That was alright for you guys. You could afford a house.
Yeah, exactly. Yeah, and that's pushing it back as well. So it definitely needs to start earlier, and it starts at school. And I think also it's getting better, but folks will pay money for legal advice. They will pay money for accountants, but still people balk about paying a good broker a fee for some good advice that would cost them, could potentially save them thousands or cost them thousands. So folks shouldn't balk at paying a fee for good advice, because if you're getting a professional service, then you get what you pay for. So there are some very good non-fee charging brokers out there. I will just caveat that. So don't upset anyone. But yeah, it's I think it's all part of the conundrum.
Brian, you want to say something there?
Yeah, I think Phil's just made a really good point. It's not just about the fee piece, but also bearing in mind that again, we're not in the investment world per se in our business, but if you take the investment world, RDR has changed the landscape, in the sense that there is a whole swathe of people now in the UK who could have, let's say, historically gone to their bank or their building society and got good financial advice across things like pension, savings and investments. And to a large degree now that has gone, because all of those facilities have largely been withdrawn by those organisations because of the cost of providing that advice and the fact that they don't feel comfortable charging fee structures. So that world has dropped into, let's use the term, the IFA world, which does a really fantastic job, but they can't cater for the number of people that need advice, and most people won't. Still, as Phil said, they bulk at perhaps paying a fee for that advice, but they perhaps don't realise that actually the advice fees in overall terms could be relatively small compared with what they're, the difference between investing in the right funds or choosing the right products with the right fees and charges and so forth against the investment returns will far outweigh the cost of the advice. But that's not generally known and explained and understood by people. So actually, in most cases, unfortunately, they're in ignorance. And in my opinion, that's a fault of sort of the regulatory environment, which has sort of ensured that a whole swathe of people in the UK that probably had access to financial advice, in good quality financial advice in the past, have probably been precluded from doing so now because of the sort of size of the sort of funds and the amount of money they feel they've got to invest is probably not worth the time for an IFA and so forth. And that's not a criticism of the
Yeah.
IFA world. That's the reality of the sort of the cost benefit analysis. But coming back to the earlier point, as an industry, financial services per se, people have qualifications in different spheres. Very, very, very few people have qualifications to advise across everything, and that would include things like ER, which of course in itself is like a separate qualification. So what you've got is people who probably should be getting a sort of generalist overview, holistic overview, and then being sort of, I wouldn't say parcelled off, but introduced to different people in the chain to get specific advice, which is obviously pertinent to their individual needs and circumstances. The issue is, though, how many times can you actually hand somebody off and make it a good customer experience and provide the right outcome? Because nobody wants to hand anybody off to anybody, really. You've built that bond and relationship with the client. You really want to sort of work with that client long term. But obviously, when you get to the end of your skills, experience, knowledge, expertise, then it's right that client is then put in front of somebody who's got the appropriate level of qualification. But as we said, it can be a very inexact process. And I think as an industry, I'm not talking necessarily mortgages, but I'm talking about the wider financial service industry, we need to do that much better. I also think, as you touched on earlier, there's a huge opportunity for advice. For education, and that needs to start earlier. And also, we can probably take a leaf out of some other countries. So, for instance, in places like Australia, I know we have sort of pension contribution now, which employers have to put in. Make schemes available to employees. In the sort of 1 percentile sort of area. But in places like Australia, everybody has to pay into a pension at a given level. That ensures a given level of income in retirement. Now, as people are working increasingly longer, and retirement is going to become in many instances shorter, and the state is not going to be providing the long term the sort of benefits it's paid historically, then there's even more need for people to understand the ramifications of not doing that.
No, brilliant advice.
Absolutely.
Brilliant advice. Good topic, guys. Good topic. That was really interesting. Okay, moving on. Excuse me. Moving on to a story from Mortgage Introducer. I know this is going to stir the pot with you guys, so I'm quite looking forward to this one. The headline is, could the Bank of England cut the base rate this year? So just picking out the story a little bit, it's from Jake at Mortgage Introducer, I think it said that. Senior Bank of England policymaker has said interest rates need to be cut this year as the pressure on households from high borrowing costs ripples through the market. Now, we've had 10 consecutive increases in the base rate. It says here that Andrew Bailey has said they may need to reach 4.5% this year. But, could it go down? Should it go down? Does it need to go down? And let's just open the floor with this one. Who wants to go first?
Yeah, I'll start it off. Yeah, it needs to go down because I'm on a variable rate mortgage and I want to pay less. But, taking my personal view out of this, I don't pretend to have any working knowledge of fiscal policy. But what I don't understand in this environment is the inflation we've got is not as a result of people spending more on discretionary spend, which is what normally drives inflation. It's the cost of staying alive. Today, the food inflation is 16.7%, as stated this morning. Pasta's gone from 50p to 95p in 18 months. So as one example. So I don't know. I don't see how pushing up the underlying rate of people borrowing money is going to solve the problems that we have. Because I think people aren't borrowing money as they were anyway because they can't afford to. They either don't want to or they physically can't because affordability models and loan engines have changed to adapt to the circumstances. So I don't know is the honest answer. And it's just there's obviously a reason for it. I know there's concern that all the big pay rises that people are getting are going to drive inflation and the cost of base rate higher to curb that extra excitement because they've got a bit more money. I don't see it personally, but that seems to be one of the other lines of thought. I can't, with everything prevailing now saying what they're saying that it's going to be at 4% inflation by the end of this year. Why do we need to keep driving it up only to drive it, the last nail in the coffin before we then start to try and unpick it? But as I said, a layman's view.
Well, one of the statements here that I have to agree with. I said this at an event last week and got shouted at. I said that the central bank was completely out of touch with the reality of the situation, and it's literally what's said in this article. It's
100%.
exactly the same thing. You've got no idea about the
There's-
real impact of what people are
There's
going
no
through.
evidence to show that they're in line with what's actually happening, because you would be doing more to understand it before just pushing it. In my view, I agree.
Go on, Phil.
Yeah, yeah. No, I mean, I think part of this problem was, with a great benefit of hindsight, is they were slow to. They should have slowly started to increase interest rates earlier than they did. I understand why they were frightened to, but they needed to have pushed that button that a little bit earlier and done it more slowly and incrementally. So we wouldn't have had all the shock. Obviously, the government chaos we had in the autumn, completely changed that, and then stuff had to happen. But I think that's part of the problem, was they were just too slow to react, and that's impacted where we are now. But whether I think there's just so many worldwide events that could potentially happen that could mean rates could go up further. If we have a good, more stable year, then hopefully we might see them come down by the end of the year. But I think there's just so many factors in play that could change it. I think we've just got to wait and see.
Brian, sorry, Phil.
Sorry, Jay, I was going to say the one caveat. I know, get Brian involved. The one caveat that I think is worth just balancing out is I think the average base rate over the last 30-year period is 5.5%.
Exactly.
So we've got to put that into context. We've just had a very, very good time as people wanting to borrow money but that's the average, and we've not hit that average at this point.
Brian, just coming to you, your comments.
Yeah, sure. Yeah, thank you. Something Phil just said there, which I think is very pertinent, in that, yes, personally, I also think the bank was slow to respond at the end of 2021. The US Federal Reserve started to put their rates up more aggressively than we did, and notwithstanding the fact that then world events, and obviously I suppose the one of the sort of trigger points, no pun intended, was the invasion, the war in Ukraine, and what that subsequently did to the cost of oil and gas and wheat and so forth. Coming back to Tony's point about pasta and so forth, not jokingly, that's had a phenomenal effect on inflation. It's doubled the cost, trebled the cost, quadrupled the cost of certain items. No central bank anywhere can account for that sort of factor, and also supply chain disruption, which is still ongoing from the pandemic. Things like that still haven't actually worked their way through the process. However, we are where we are. Bank base rate now appears to be, or is looking likely, that it's either at its peak or very close to. So whether we get another quarter or a half point, I personally think in the grand scheme of things is really neither here nor there. Because if you look at when base rate went up in beginning of this month in February by 50 points, mortgage rates didn't move, because obviously the swap rate market had already factored in those sort of expectations. In fact, if anything, bank base has gone up and mortgage rates have actually dropped by around about 1% over that last 4 or 5 week period typically, which is slightly bizarre, but that's the reality of the world we live in, and that's a good thing, don't get me wrong. Have rates hit their peak, and are they likely to drop? I think they are probably likely to drop. Whether that happens this year, again, I don't know the answer to that. I don't think any of us do. I don't think the bank know the answer to that either. Expectations are that they will probably start to recede during 2024 and may have fallen back fairly considerably if, as we all expect, inflation gets to the sort of levels as alluded to. So possibly maybe 4 or 5% by the end of this year, but who knows? At the moment, the things like the price of gas have diminished quite dramatically relative to where they were, $400 a therm, now down to about $130 a therm, but that's still 2.5 times the level of it was pre the war in Ukraine. And all those sort of things will, as we said, they're volatile, they're dependent on a whole raft of factors, none of which we can control. And so I think the bank will take whatever path they feel they need to take in order to achieve or try and achieve what is their only effectively agenda item, which is to control inflation, because that's the only thing they're really tasked with doing. You could argue they've been pretty unsuccessful in achieving that, although as I said, without defending them, I think other factors have got in the way. And at the moment, it's the expectation is that if and when inflation falls, and maybe in a year or 18 months' time, it gets back to sort of likely levels, it was probably going to undershoot the 2% target. Which again, coming back to your point about should they be reducing rates now, should they be reducing rates this year, as we've already said in the call, that the brake on inflation is already apparent in terms of the fact that most people have got renewed their mortgage in the last 6 months. Their payments have probably at least doubled. Most people, when they go to the supermarket, they're paying twice the price for a packet of pasta they were 12 months ago. So you could almost argue that is the effect that inflation has had. People are their spending is being curbed by other factors. And also to support Tony's comment about pay rises, yes, pay rises have been significantly above where they've been for the last 3, 4, 5 years. However, they're still broadly half to 2/3 of where inflation is. So people have still had a real times pay decrease. And in addition, when you look at the taxation changes that have come in as well, where a lot of people, because of things like tax thresholds have been frozen for upper rate payers and so forth, suddenly people that were lower rate taxpayers, they get a pay rise of 6 or 7%. It takes them through the 50,000 barrier, and suddenly they're a higher rate taxpayer. Ordinarily, if those thresholds had been allowed to rise in line with inflation, they'd be paying substantially less tax. So there's a further break on people's expenditure. So again, I personally think that this constant drive for following the BBR, it seems bizarre, but I'm not an economist. What do I know? As I said, I'm a lay person as well.
I had a really interesting conversation with an economist on the radio show last weekend, and we were talking about inflation. And I was just looking at the inflation figure. I'm no economist, obviously. I don't really know much about the financial services market. I'm just a host. But we were talking about inflation, and something Tony said reminded me of what he said, in that inflation is calculated on a whole different variety of factors. But if you don't fit into those certain factors, sometimes the food inflation is all that affects you. So actually you're hurt more by food inflation than anything else, because you might not drive, you might not have a mortgage, and then those that have mortgages but on the lower income rate, and then they've got a family, then again it's a balance across all different markets to create that inflation figure. But actually, when you look at it, your individual inflation percentage could be up to 16% where food is, not on where they say it is. So actually society is affected in multiple different ways with inflation.
And that's particularly true, dare I say, of people who are tenants as well. So, where landlords have perhaps had their mortgage payments increase substantially, invariably they will look to recoup most of that, or all of that, from their tenants, and therefore the rise in rents have gone up probably in excess of inflation relatively. And of course,
I have to say, I've been really warmed by the amount of stories I've seen of landlords that have only just sort of teetered up their rents and actually trying to absorb some of the impact because they respect their tenants. Indeed. I mean, there's a lot to be said about these buy-to-let borrowers. These landlords. They're good people. They're not all bad people. It's not. There's no way to slate them. I'm actually nothing but positive.
Absolutely. No, I'm not making.
Good conversation.
I'm not saying landlords good. I'm not detrimenting landlords. What I'm saying is, but the reality.
No, not at all.
And in response to your question, you're absolutely right. It's the tenant market probably that's been most affected by the effects of inflation, because a significant proportion of tenants' income is paying their rent, and in addition, as you say, paying for just their basic things like foodstuffs, which, as you rightly said, is actually suffering from a higher level of inflation than RPI in general.
There is another cost coming. Haven't you seen that local authorities, most of them are going to increase council tax by the maximum 5% they're allowed?
Yep.
No, not just 5%. Essex, one of the Essex counties has gone up by 10%. I don't know how they've been allowed to do that, but I think I've even heard one at 12.5%.
Really?
12.5%. How is that legally possible? Surely you're supposed to have a referendum on that after over a certain percentage.
That is a super stealth tax. It's rising and rising and rising. It's frightening.
Yeah.
And yeah,
Correct.
and then when you live on your own, and you don't get much of a discount either. I mean, I get what do I get? A
Well,
third off, I
25.
think. A third off my
No,
council
20,
tax being single.
25% only.
Is it 25? 25.
25.
I don't know.
Yeah,
I
single
just pay
person.
it.
Yeah. Yeah. No.
Well, there we go. Cost of living's going to be eating us up for a long time to come still, but there is some positives to look forward to. It looks like there's some light at the end of the tunnel. Let's see how things pan out. I'm going to move on to a subject that I know absolutely nothing about, so you guys are going to have to bear with me on my ignorance, and we're going to talk about second charge mortgages.
Okay.
With this story that 90% of homeowners are open to second charge mortgages this year to help with existing debt and loan consolidation. Now, we've talked about this a bit, but obviously I know nothing about second charge mortgages. So educate me, guys. Brian, I'm going to come to you first from a market perspective. Tell me what a second charge mortgage is and why they're suddenly becoming a bit more popular.
Okay. So a second charge is, as the name suggests, it's a secondary charge behind your primary lender's first charge. So if I have own a property and let's say I have a mortgage with the Saffron, as I would do, of course that would be the first charge. I then perhaps need or want to raise some additional financing for a variety of purposes. I might want to might want to retrofit my property to make it more environmentally friendly. I'm perhaps on an extremely attractive rate. Maybe I'm 2 years into a 5-year fixed rate with a lender today. I might be paying a mortgage rate, let's say somewhere between a 1% and a 2% as an existing customer. To remortgage myself away to consolidate the amount of borrowing I want to take plus my existing borrowing would be probably financial suicide, because I'd be giving up my 1% to 2% and probably rolling into a 4% or a 5% deal. So I park my current deal where it is, I leave it where it is, and I take what's termed as a second charge, which means that in the event of a foreclosure, the Saffron in this case would have first dibs on the property. The second charge lender would only get their money after the first charge lender has recouped theirs. That's broadly how it works. You can, in theory, even have third charges as well. There are one or two finance companies that offer that sort of facility. It's not something that, let's say, mainstream brokers tend to advise on directly. Where we identify the opportunity for second charge, most brokers, not all, but most brokers, hand those clients off to what we would call a specialist or specialist packager business, or specialist broker business who specialises in second charges. The range of providers in the market is far more limited than first charge. So as a first charge mortgage broker, we typically deal with 100 plus lenders per annum. I think I'm right in saying there's maybe no more than about a dozen or 13, 14 lenders in the second charge market typically. Loan sizes tend to be substantially smaller because, again, it is a secondary loan. So whereas a typical first charge mortgage might be in the order of, say, £200,000 across the market, second charges are probably sort of 40 to 60k, somewhere in there. Sort of. They can be higher. Some lenders will lend sort of up to £250,000. Some I think will even go beyond that. And terms range, again, typically from sort of 5 years up to 30, 35 years in a similar way to first charge mortgages. And interest rates as well tend to be a little bit higher, but probably not as high as they were some years ago. There was quite a big market differential between the first and the second charge market. So it can be a really good and efficient way of a customer gaining access to capital quickly should they need it, and not disturbing their primary lending. Or if, for instance, again, another situation would be if the customer, having had a very good existing deal, and let's say maybe their credit circumstances have changed in the intervening period, and they needed some capital for some further circumstance, to go and remortgage would mean that they're remortgaging out of a really good deal onto probably a lesser deal because of their credit circumstance, and you can you can take a second charge with another provider. Obviously, your circumstances will be fully assessed as they currently stand, and you will be paying a higher rate for that second charge, but you're not disturbing your primary lending is the key thing. So you're sort of protecting your rate, I suppose, is the way you do it.
Yeah.
Are they increasing? If I'm honest, I don't see any evidence of that. But again, it's not a market that we're in directly. I think the numbers, if you look at the sort of the gross lending in the market, it's I think in the region of about £2 billion a year on an annualised basis.
1.71 billion to be precise for 2022
Sorry.
anyway.
Sorry, Joe, can you repeat that?
1.71 billion in 2022, so it was up by 45.3% in 22.
But if you go back about 10 years, it was about £4 billion 10 years ago. So on that basis, it's actually a
Wow.
smaller market, and yet house prices have actually gone up exponentially in that time frame as well. So then, and that also, I think, reflects the number of participants in the market and the lack of product availability in the market relative to where things were. So yeah, look, they're a great source of funding for clients with certain circumstances. Are they going to be the next big thing since sliced bread? Probably not. I think they're the right product for the right client in the right circumstance.
Tony, I would hazard a guess that this 45% increase over 22 is to do with the cost of living crisis and the debt consolidation side of it rather than the refurb side, isn't it? Is people going, actually, if I chuck it all in here, it's a much lower interest rate than what the rest of my products are. I presume that's what we can take from this story and this growth, isn't it?
I think so. Look, I mean, it came more to prominence after the last kind of round of regulatory changes, where it was incumbent on advisors to advise effectively and just not just say, this is what you need to do. They have to consider the existing lender, the a remortgage option, and a second charge option. So the growth was driven a bit by the advice that needed to be provided to support it. And yeah, look, second charge, it's not something we deal with. As Brian said, it's largely, from an advisory perspective, it's the bastion of specialist packages that will take these cases from individuals, because it's complicated and it needs to be looked at appropriately. But yeah, a lot of it's debt con, as you say. It's more expensive than a first charge mortgage, as Brian has said, but it provides a far cheaper option than funding a credit card or a personal loan
Yeah.
generally. So you know, yeah, it's an appropriate product for the right person.
We're just reading on. I've just read on, and November and December saw a dramatic drop. So actually, it was the start of 22. So perhaps it was major panic during the initial onset of the cost of living crisis, and actually people have sat back at the end of it and gone, no, maybe not. But it does say here that 43% of people didn't know they exist. Hence why I had no idea what I was talking about. So there is education, I guess, and if it's the right product for the certain person, I guess.
Yeah, look, it's
Absolutely.
don't know it exists, but sorry, Brian, you carry on.
No. Sorry, no. You carry on, mate. I'll jump in a second.
Yeah.
Good.
It goes back to Phil's point about education, right? Most people in the UK don't really know what a mortgage is, all right?
Yeah.
So having only 43% knowing what a second charge is actually quite good for us, bearing in mind our state of financial education, if I'm honest.
The worrying thing is, Tony, I think it's 43% of mortgage borrowers. So that's a little bit worrying. It's not someone who doesn't know what mortgages, but these are the people that do know what mortgages is.
Right, okay, fine.
Sorry, Brian, what were you going to say?
Sorry, I've lost my train of thought a little bit now. Oh, sorry. Yes, I know what I was going to say. Yes. One of the advantages of a second charge can be the speed in which the funds can be made available. So typically what will happen is if a broker's got a client situation that a second charge would deem to lend itself well to, they can approach the specialist packager. The specialist packager will arrange for evaluation, get various documents completed on behalf of the provider. Normally they require the consent of the first charge lender as well. But in a fairly typical scenario, often the funds can be made available in a matter of a couple of weeks. So if somebody had a real sort of, let's say, urgent need, maybe something like paying of a tax bill or something of that sort of nature, funds can be realised quite quickly. Which obviously, when time is of the essence, that's obviously hugely appropriate.
I think Brian's right there in terms of actually the usage of the funds. The second charge lender has a broader spectrum of usage than perhaps a first charge lender will. Yeah.
Yeah.
So most first charge lenders won't lend money to pay for business purposes or funding tax bills. Okay.
Yeah.
But as Brian just said, second charge probably would. So I don't want to use the word looser, but I think there's a broader application of the funds that they will accept. So that's when it becomes an option. But as anything, there's a price for it.
There we go. Right. I'm going to leave that. Phil, I'm going to come to you first on this next story. Does everybody want to just quickly polish their crystal balls for me, please? Because we're going to talk house prices again, because we know how good these predictions always are. Right, so according to the lovely Lloyds Bank, the next one to jump in on this house price thing, they're saying that house prices could fall by 7% this year because customers are struggling with mortgages. How many times we do these stories? And I bring them up every time because I just love the conversation that comes out of these. And I reckon when we listen back to previous podcasts, we'd laugh at ourselves because, we bring up these stories that are going to drop by 15%. So here we go again. So the forecasting will fall by 7% this year. Nationwide predicted 5, Santander 10. Nobody on the money with each other. They're all got different figures. Phil, you first. Are house prices going to fall this year? Because they didn't fall dramatically last year as everyone wished they would, or thought they would, or predicted they would. They're going to happen this year?
They might. I think, look, that we're not going to see the. I think what is certain is we're not going to see the house growth that we've seen that's been unprecedented for the last, 15, 20 years. Well, certainly since the credit crunch, we're not going to see that growth that we've seen. So, I think they're not going to grow as much, and I think we're seeing some regional trends as well. So. The top end of the market doesn't seem to have been affected, in all sorts of ways. I mean, we've got a broad range of mortgage brokers that we interact with. So we've got some brokers who specialise in high net worth clients, and that end of the market isn't going anywhere. In fact, that's improving exponentially. But I think generally across the market, I think we're seeing we'll see some softening there. But house prices is all about confidence, isn't it? So it's just what sort of year we're going to have.
Brian, polish your crystal ball. What's your thoughts?
Yeah, I absolutely don't disagree with anything really Phil said there. And just to sort of add my sort of flavour, certainly, we've got a lot of estate agency introducers and business partners within our business who are estate agents, and obviously sort of seeing markets on a daily, weekly basis. We're not seeing across the market wholesale price falls at all. We're seeing some price adjustments on some properties that are for sale, where perhaps properties have been on the market now for sort of 4, 5, 6 months. Clearly agents are having conversations with the vendors around small price reductions in order to encourage activity and viewings and so forth. But there is still a market. I think what people sort of sometimes lose sight of is that regardless of where interest rates are, regardless of even where things like consumer confidence are, which is again hugely important, and regardless of where things like inflation are and cost of living crisis in general, there is always a housing market made up of things like births, deaths, marriages, separation, additional children, etc. Or perhaps in some cases the need to downsize because somebody's become infirm and can't maybe live in a 2 or 3 story house anymore, maybe needs to move to a flat or a bungalow. So that creates transactions, which is the key thing, and there is that sort of nucleus of activity always in the market, regardless of what happens economically. If you look at the UK housing market transactional activity over, say, 15 or 20 or 30 years, it's in the order of about 1 million to about 1.7 million transactions a year, depending on the sort of economic activity that's going on. I think last year, 2022, was in the order of about 1.3 million transactions. I think 1.4 million in 2021. So that's been a slightly higher market than in the sort of 16, 17, 18, 19 period, which again was sort of plagued, shall we say, by the sort of fear about the Brexit vote and so forth. It made people sort of sit on their hands for a couple of years and do nothing. And then when Boris won the election in 2019, that seemed to sort of stimulate the market almost overnight. We then had COVID. Obviously, the market went into hibernation for a period. It then got the stimulus of stamp duty when we all sort of came out of lockdown and so forth. And we had a very active and buoyant market in which the market's probably seen double-digit growth for 2 years running. So we've probably seen sort of 25% house price inflation over a sort of 2-3 year period. Are prices going to fall back? Yes, they'll probably ease or soften, I think was the word Phil used, which is the correct word. Are they going to fall back by 10, 5, 7%? Who knows? It will be a combination of local factors and supply-demand activity, because at the moment the level of market supply is still relatively small, and yet there is a relatively strong level of buyer activity out there in spite of all the economic challenges and hurdles that we see in the market. So the market will find its natural level. I think it's also just worth saying that, notwithstanding the debacle of last September's mini budget, call it what you want to will, and what that did to interest rates, affordability was becoming a challenge anyway, particularly in the first-time buyer market. People were getting to the sort of the upper end, the upper tier of their threshold borrowing levels based upon normal incomes. And what we were seeing increasingly was sort of the bank of mum and dad and so forth having to step in and provide additional deposits because prices were rising, and the ability, therefore, if people are renting, to sort of save that additional deposit becomes ever further and further out of reach. So that there comes a point in any sort of economic cycle where the market has to find a plateau and things need to catch up below. And I think we'd probably reached that point. And then we got to the point where interest rates, as I said, went from sort of typically pay rates of 1 to 2%, depending on where you were in the market, to now sort of 6%. And all right, they've eased back now. We've now got some rates back down below 4 again, which is really welcome. But that's still a huge jump relative to where the market was just a year, 18 months ago. And therefore people's debt servicing costs have gone up dramatically, which will also limit how much they can borrow. So ultimately, there has to be an adjustment in prices in order to bring things back into to target. I'm not giving you a forecast. It's perhaps what I'm saying in a very long-winded way.
You tell I'm digging for it. Nobody's biting. Tony, coming to you. Brian just nicked my thunder there because I was going to come to you with the first-time buyer market, because there are some people that need the prices to drop, aren't there? So, we need to see some balance. And I think Brian's right. All this buoyancy is great, and it's good if you're already on the market. But if you're looking to get on the market, it's almost impossible. So, we do need a little bit of a drop. So, what? Go on, predict.
Well, look, I know there's nervousness amount in the higher loan to value lending is at risk here. If you've got 95% lending and house prices dropping by 7 to 10%, there's a potential risk on that straight away. But going back to this article, I love the words "house prices to tumble." That tumble to. I think the bigger line in this article, before we carry on, is the fact that Charlie Nunn earned 3.8 million last year as the CEO of Lloyd's, which is the secondary headline of this article. That's the one we should be discussing.
Absolutely.
But first time, look, yes, it'd be great if they were, there's winners and losers in every market, in every cycle, isn't there? At the first-time buyers are getting squeezed. We know that that's not a new phenomena. I think the beauty is, though, for first-time buyers, there are more and more opportunities to get on the ladder using support. I know that the government support through Help to Buy is waning, but there are, Bank of Mum and Dad is the 6th largest lender in the UK now. That's one thing, and there are a whole load of schemes available from lenders to enable first-time buyers with a 5% deposit to get on the housing ladder. And with not punitive terms. Us being one of them with our joint borrower sole proprietor product, which it is, I won't do the shameless plug, but it's one that we're seeing that being increasingly used more and more. Who they can afford 70% of the affordability, but need someone to just top up the rest, and that's what we're very good at doing. So I think it's just one of those things. Yeah, look, the real reason it's hard for first-time buyers is we just don't build enough houses, which is a whole new subject, as you know.
I've left Phil till last because I know how much he loves this subject. So, Phil, I've got some good news, London good news, that the Mayor of London has diverted some funds to build some affordable houses on the outskirts of London. So they're taking it from road projects and building new houses, which is exciting. 25% of them social houses, 75% being affordable homes in the home counties. That's a good story. We talk about this a lot. There is a supply and demand is the issue, and there's not enough affordable homes. There's a gorgeous estate, Brian will know, he lives close by. A gorgeous estate's been built near Hunstanton, to the outside of Hunstanton, a lovely seaside town. Across the whole entire estate, they're all, 3-4 bedroom houses. There's actually no 1 bedroom, 2 bedrooms, like first time homes in there at all. And I look at it and think, how disappointing. So, Phil, I know this is a subject that you love, but that is the issue, isn't it? We need to build more affordable homes.
Yeah. I think we say it on every podcast. I think we've said, or certainly everyone I've been on. Yeah, it's all about supply and demand and housing stock, and there's the demand for home ownership doesn't stop. and we until we address that, then house prices are gonna still keep rising ultimately.
And it relates to what you said, Phil, very much so, in that the high end, the high net worth homeowners are not being affected, but the lower end is increasing because of the demand.
Yeah.
So, you know, it swings and roundabouts. You know, you build the homes, we might knock it down a little bit. Not the houses, the rates, the costs. But okay, we're going to have to leave it there because we do have another subject, but we're going to have to leave it there because we've run out of time. But that's really interesting. And again, if anyone from the government's listening, build more homes, please, and encourage the construction companies to do the same since they're in your pocket. And we can get some affordable homes on the market. Thank you very much. That was really interesting. Some really good topics. We have missed one, but just for everybody to know, it was to do with mortgage rates falling, but we did cover it in the other topics. I think we covered that quite well. They are coming down. Lenders are, below the base rate and pushing downwards, so that's a good thing. So, Brian, thank you. First podcast. I hope you come back again.
No, very well done. Enjoyed it. Thank you very much.
Definitely come back and join us. And Phil, Tony, thank you very much. It's very educational, as always. Just to caveat again, this was recorded on the 24th of February 2023 and released in March 2023. So some of the information we gave may be slightly out of date. That's it from us then. So we'll be back released on the 1st of April next month. So do listen out for that with our new guests. And we, if you catch it in time, we've got our next webinar on the 1st of March. We'll give away a topic, so you may get an email from me in the next few days that we've recorded this. Email from me inviting you to that. Do come along and join us. So from me and the rest of the panels, let's thank you for listening, and goodbye.
Thanks everybody.
Thank you. Cheers.